right now. So unfortunately, our fiscal situation will, I don't see a correction to it in the short to intermediate term.
And Ralph, a lot of folks share your concerns, but what is the outcome of that? If we don't get the fiscal house in order, what does that actually look like?
It probably looks like a not good ending at some point. And I think no one is smart enough to predict when that point will be. It will probably be catalyzed by some exogenous event that will cause people to focus more aggressively on our long-term fiscal imbalances. I have no idea what that event will be, but in my view, this does not end well.
Yeah, especially when we're considering interest payments as a percentage, or at least as a line item in the federal budget. In not so distant future could actually be the biggest expenditure the U.S. government is facing, which kind of brings back to where we started the conversation, Ralph, about the idea that rates may stay higher for longer, that borrowing costs may just be much higher for the time being. When I look at what the market is doing today, a massive rally in stocks, a massive rally in the bond market as well, with yields dropping substantially, what that amounts to is an easing of financial conditions. And I wonder, to the point you were making earlier, if actually, even though inflation data is tracking the right way, if financial conditions don't tighten enough because the market is like everything is great, if the Fed's going to have to push back on that anyway.
I doubt that, and I think there's significant lags in the impact of Fed policy. So what we're seeing and will see over the next few months is the impact on the economy, the real economy, of the tightening that has occurred over the last 6 to 9 months. That impact has not been fully felt yet, and we certainly see the early signs of a slowdown in employment, in investment, in retail sales, and I personally believe that continues.
Ralph, let me give you the argument that I frequently hear about this idea that equity markets are going to be okay next year. And it's that small caps have reflected some of the economic weakness. The Russell 2000 at an all-time low versus the NASDAQ. I mean, not today. It's up some 4% off the back of those CPI figures. But that it's just the Magnificent Seven that's been holding up the market. And actually, stocks have reacted to the weaker environment. That's already been priced in. What do you say to that argument?
There's a lot of validity to that, but if we're talking about the averages, first of all, the Magnificent Seven trade at a very STEMI multiple, more in the 30s rather than the 19 or so that the S&P trades at. And there are significant parts of the stock market that have been left behind the recovery in the indices themselves. So there certainly is an opportunity for some catch-up on the part of small and mid caps, but they also are the part of the market that will suffer the most in a period of economic weakness. So while the PE of those stocks might improve, the E is more at risk.
Well, when we think about economic weakness, Ralph, I'm speaking to you from Washington, somewhere I know you spent a great deal of time. When we think about when that real softness is going to show up, knowing we are about to enter a presidential election year in 2024, how much do you think the economic timeline might work against an incumbent Democratic president?
Well, my own view is that the period of maximum economic risk is probably second, third, fourth quarter of next year, which obviously is not a great thing for anyone who's in a political office today. I'm certainly not saying that that's a certainty, but I do think if you look at what, there's an old saw that you hear, you never have a recession during an election year. The reason that saw exists is fiscal policy tends to be stimulative. We talked earlier about how high the deficit is already. So the opportunity to layer on additional spending or tax cuts next year is very, very limited. And I think the probability of significant Fed stimulus or cutting of rates is also less probable. It's certainly not limited because we're now at 5.25 to 5.5%.
It's interesting, Ralph, because I've heard that argument too about it being an election year and what gets accomplished also being talked about in the context of the Xi-Biden meeting. I was speaking with Andrew McCaffrey, the CIO of Fidelity, who is saying that there's a real chance that's being underestimated, that there could be some tariffs taken off the table, some Trump-era tariffs, which to someone else said to me, in an election year, absolutely not. Do you think that there could actually be some real progress, again, not just sitting down, but even more than that, to come out of San Francisco this week?
Well, I think there's no question that both the U.S. economy and our markets and the Chinese economy and their markets would benefit from a tamping down of the stress in the relationship between the United States and China. I'd be skeptical that there will actually be a removal of tariffs because sadly, one of the things that there is almost universal consensus on in the Democratic and Republican parties is bashing of China. Perhaps we could, one thing that would be a very positive thing would be a resumption of communication between our military leaders and the Chinese military leaders. As you know, that's been completely discontinued as a result of the increase in tensions, and I think that would be a very good first step.
Yeah, specifically, Speaker Emeritus Nancy Pelosi's visit to Taiwan is what really severed those ties. And of course, that is one of the main issues for President Biden as he gets set to meet with Xi Jinping in San Francisco on the sidelines of APEC tomorrow. Ralph, when we think about that meeting in particular, and this really comes back to the conversation we were having about the health of the U.S. economy, who is coming at this from a greater position of strength? Who do you think has the most leverage here, given we know that there are fragilities in the Chinese economy as well?
Well, I think actually the United States economy has been the true standout in the world this year, certainly outperforming Europe, outperforming China. So our relative economic position is unquestionably stronger than China's. On the other hand, there's no one in China who's threatening, even in the most remote sense, the position that Xi Jinping has as the leader of the country. And obviously we have an election coming up next year where that will be decided. So I think there are puts and takes on both sides in terms of this relative strength of position.
And Ralph, it's not just Biden, but it's also, some of your fellow peers in the business world that's going to be meeting with Xi, everyone from Jane Fraser to Elon Musk, ExxonMobil executives, Microsoft executives. If you were in that room, and let's be honest, Ralph, we all wish we were in that room or at least a fly in the wall, what would you want to hear from Xi?
I would want to hear that that their economy is going to, they will take real steps toward opening their economy and removing government fiat from the risk to any investment that's made. I think there's been a real step backward in China, and businesses responding to that by redoing supply chains, and the whole concept of the degree to which one invests in China has been affected by the appearance of somewhat mercurial or unpredictable behavior on the part of the government there. That's very hard when you're investing lots of money.
Well, Also, Ralph, when we think about just investing money with knowing the challenges of not just the relationship between the U.S. and China geopolitically, but also this idea that they are on opposite ends of a lot of conflicts throughout the world, including the war between Israel and Hamas, between Russia and Ukraine. And when we think about all of these things collectively, do you think that this market has an appropriate understanding and pricing of the geopolitical risks that are out there?
That's a good question. I think as a general matter, no, that the world is underestimating the potential disruption that can come from these geopolitical risks. On the other hand, I do think what the market is also reflecting is the fact that of all the places that one can put one's money in the world, the United States is probably the safest and has some of the best growth prospects of any market. So yes, it can be disruptive, but on a relative basis, the U.S. is a great place to put your money.
Well, and you certainly are seeing U.S. stocks flying today on the back of the CPI data that we began that conversation with. Thank you so much, Ralph, for taking a quick trip around the world with us today. We really appreciate your time. Ralph Schlosstein, Evercore Chairman Emeritus. Thank you. Now, still ahead, there aren't too many iPhone 15s in Santa's sack this year. That's the word from Foxconn as they see a worrying demand picture this holiday season. We'll have those details in the startup next. This is Bloomberg. It is 22 minutes past 7 on the West Coast, where a beautiful sun is rising over San Francisco. Let's get to the startup now, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ledlow. And Ed, we have to talk about the iPhone 15 as holiday shopping season, believe it or not, is upon us. I already have my Christmas list going, but apparently maybe not a lot of people are going to be buying new iPhone 15s for family members and friends. At least that's the indication from Foxconn. Walk us through their warning here and whether it should be surprising given what we've already heard from Apple.
It's another case of reading the tea leaves, right? So Foxconn is the main contract manufacturer that assembles the iPhone for Apple. And what it said was that in the holiday quarter, sales will be down. And it will be the third straight quarter consecutively of sales declines. Analysts think it's a drop of around 4%. And we take that, given that it's the main contract manufacturer that assembles the iPhone, to mean that this continued slide indicates that the demand for iPhone 15 is broadly not there, compared to the same period a year ago when Apple released the iPhone 14 generation. And it kind of tallies with the third-party data that we've discussed in the show a lot recently.
Yeah, I was going to say on that point, Ed, I mean, Apple is higher because literally everything is higher today off the back of that CPI report.
True.
But even before CPI came out, pre-market Apple was little changed. Are Apple investors going to look at this and say, okay, I've learned nothing new?
Well, the first thing is that in the quarter just gone, the third quarter, Foxconn or Hon Hai Precision, the kind of main publicly traded arm of Foxconn, had an impressive net income figure of $1.3 billion above expectations. So it might have indicated they did better in that quarter and that there could have been some kind of higher concentration of production of 15 handsets when they were first released, right? The other thing is, go back to the earnings call. A lot was put on emphasis on China, that overall Apple's China revenue missed estimates. But the commentary was that if you strip out the problems, which was iPad and Mac, where there was not a new generation of products, and on a constant currency basis, Apple actually saw the iPhone growing in Greater China. And that went some way to kind of allaying concerns about how it's gone down in that market at least, while third-party data is also showing some strength in North America. So it might not all be as gloomy as we think.
Yeah, but that was the backward look at the quarter they had reported, a quarter that I believe ended very shortly after Huawei launched that Mate 60 Pro smartphone that will directly compete with the iPhone. So do we really know yet what kind of market share it might be eating into?
Yeah, of all the big technology companies we cover on the earnings call, you kind of put the most emphasis on what Tim Cook and Luca Maestri, Apple's CFO, actually say. And Tim Cook reflected on a recent visit to China where he said that they identified themselves as having the top 4 handsets in China's smartphone market, but also recognizing that overall the smartphone market in China is contracting. And the conclusion the market drew was, well, hold on, if you're saying you've got the top 4 phones, but in a shrinking market, you're saying that you're growing market share, which kind of pushed back on this idea that despite the sales they did post, they're not losing out to domestic handset makers. But then look at the Counterpoint research data out overnight, and it does show momentum in some of those Chinese domestic smartphone handset makers. So it's a thing, you look at the data over a series of 2 years, 1 quarter a market does not make.
Yep. Never wiser words were said. Ed, thank you very much. That is Bloomberg's Ed Ludlow. And of course, you can catch him and Caroline Hine with many more wise words on Bloomberg Technology. That comes up in about 90 minutes time. Coming up on this show first, though, small business optimism at historically low levels. We're going to discuss with the NFIB next on Bloomberg.
We are about an hour into the U.S. trading session. Stocks are flying, bond yields are plunging. Abigail Doolittle, thanks very much to CPI.
That really is the story here, Kaylee, and here it is right here on this board. The S&P 500 up 1.9%, the NASDAQ 100 up just a little bit more, up 2.1%. This is the best day for both of these indexes in about 2 weeks, and here are yields plunging. That two-year yield down about 18 basis points at 485, 486. The 10-year yield at 445, also down 18 basis points. What's so interesting about it is that the print coming in cooler than the formal expectations, not by such a big degree, but market participants right now seem to think that this is the end of inflation. I would say that there's probably more data to be watched and, of course, to hear from the Fed, but that's what the market is telling us. However, if we go into the Bloomberg terminal and take a look at the two-year yield, it is still hanging on to the near-term uptrend. This is not the prettiest chart, but you can see since June, basically, the two-year yield hovering around and above 5% in a pretty neat range. Today's plunge takes it right to the bottom of that range. The RSI is actually moving higher. Here you have the two-year yield lower than it is here. The RSI was lower. The fact that the RSI is actually higher, that's a little bit of a divergence. So I think that investors want to wait and see whether or not we continue to see yields come in. We may, but this chart does provide some reason to think that it may be different. As for some of the really outsized movers, take a look at the Russell 2000, up 4.2% on the day, the best day since November of last year. Small caps so beaten down on the year, so a little bit of a catch-up trade there, at least right now. Regional banks, a piece of it. Take a look at that, up 7.3%. The home builders up 6%, also the best days of the year, at least for the home builders. And then autos up 4.2%. As for the S&P 500 itself, this chart is so ugly, I would usually not want to show it, but it is useful. There is a range that we've looked at a couple times, not so many times over the last few months, but here it is going over the last year, and you can see here, this is the near-term range we've been watching, very reliable to the downside, now breaking out to the upside, but we're now right at the top of this other range. These ranges represent battles between the bulls and the bears. The RSI is almost at overbought, so many different levels of uncertainty over different time periods. I would say both of these charts, Danny, suggest that it's too early still to know whether or not the inflation fight is truly over, what direction yields are going, and what direction stocks are going. Lots of ranges and lots of uncertainty.
Yeah, at least for today, a remarkable everything rally. Abigail, thank you very much. Abigail Doolittle. Now, perhaps some of the optimism in the stock market contrasts with small business optimism. It has hit a 5-month low on continued concern over inflation and persistent labor shortages. Let's get some more details from the survey's author. We're joined now by Holly Wade, the executive director of the NFIB's Research Center. Holly, thanks so much for joining us. On the survey, a net minus 17% reported higher sales. That's the smallest share since July 2020. We're talking about this in the commercial break. It doesn't seem to be getting any better. Is this the nadir, or does it seem like sentiment might slide even further?
Well, they're certainly still pessimistic about business conditions going forward, especially with 22% still saying inflation is their single most important problem in operating their business. And with the labor shortage still very much a challenge for small business owners, they're not seeing much relief on that front. But looking at the main problem with this optimism index, what was pushing it down for October, was earnings, and that dropped 8 points from last month, and that was a huge kind of transition from where we were, with more small business owners saying that earnings were lower this last quarter than the previous. And so that was one of the notable impacts that we saw from this last survey's results that were contributing to the dismal outlook on business conditions.
Yeah, so Holly, it's interesting to think about that side of the balance sheet, the money that is coming into small businesses versus the money that they're having to pay out, especially in regard to labor, knowing that there has been such a shortage and that has meant that they are going to have to offer higher wages. What is going on that front?
Not much. They still seem to be very challenged with trying to find applicants for those open positions. We're still at 43% of small business owners reporting that they have an open position. That is most prevalent in a few industries, including construction, transportation, and even retail. So small business owners are still looking to fill those positions. They're increasing wages and compensation to try and do that as best they can. But, it's very frustrating when they're looking at an environment of lost sales opportunities because they aren't able to fully staff up.
Now, we did get a CPI report that's given this market a lot of cheer, coming in ever so softer than expectations, but enough to really gear up the juice in terms of this market. I wonder if for small businesses this is a positive, or if, Holly, some of that disinflation is coming from a weaker consumer and ultimately is not good for small businesses.
Sure. So, the pressure of prices and inflation, hopefully that's easing up a bit for small business. They, might be a little bit longer to feel any relief on that front. But when we look at the decline in those, or the lower levels of those saying that they had higher earnings, that pretty significant drop from last month, most of them are saying that lower earnings are a result of higher prices. And so that is the biggest factor for those saying lower earnings. Second to that is lower sales volume. And so still that price pressure is eating into their earnings and causing a lot of problems on that front.
Okay, so when we think about the degree of pricing power or not that these small businesses are facing, simultaneously with the fact that because inflation has been so high, borrowing costs also are high, that seems like it doesn't paint a very good picture in terms of capital investment and expenditures.
Sure. So in our last survey, we did see a bit of an increase in the number of those who said that interest rates and financing were their single most important problem. Still, it's only 5%, so most small business owners in our survey are reporting that the ability to access financing is not a significant problem, although it is causing still some pressure in absorbing those additional costs. As far as capital expenditure plans going forward, that didn't move from last month, so we're still seeing decent numbers there as far as investing in their firm or planning to invest in their firm. They're just having to pay a higher price for it.
Holly, we had Home Depot earnings earlier today, which decidedly is not a small business. It is a very large business, but they talked about this mix of consumers unwilling to spend on big ticket items and instead looking to smaller projects. Have you heard that sort of similar sentiment in how much folks are willing to spend?
Certainly. So in talking to our small firms, when we ask them about financing, in our survey, it shows that, very few have that as their primary problem in operating their business. But when talking to them about financing pressures, it's on the side of the business owner in higher costs in financing, but also if their business, their customers for their business are typically financing the service or good that they're purchasing, that's also causing a lot of worry and problems concerning small business owners in how that will impact their consumer base going forward. So that's certainly a factor for some small business owners.
All right, Holly, we have to leave it there. Thank you so much for joining us on this latest data. We really appreciate it. Holly Wade of the NFIB. Now coming up, we turn to the future of carbon capture. We'll talk to Daniel Rice, Net Power CEO, about his company's plans for a utility-scale clean energy power plant. This is Bloomberg. Well, Net Power reported results today. The company is squarely in the center of the energy transition. It's designing a utility-scale clean energy power plant that may be operational by the second half of 2027. Shares, though, down about 20% at the moment off the back of these results. We're joined now by Daniel Rice, Net Power's CEO. So, Danny, thank you very much for joining us today. If we could just begin with your results, a wider loss reported than expected. Clearly, you're getting punished for it in the market today. When can you tell investors and traders things are going to turn around?
Yeah, sure. Great to be with you today. So I think it was actually less about the results for the quarter. We're a pre-revenue company. We're developing and designing and inventing a new type of power generation plant that uses natural gas and converts it into essentially carbon-free power. So it's totally transformative to the power industry. I think expectations are very high of us. Anticipation of what we're delivering to the market is incredibly high, just because the world needs access to clean, affordable, reliable power, and it really is a solution that we think only Net Power can deliver. And so the market is asking us, get us these plants as soon as you possibly can. And I think what we talked about today on our earnings call with investors and disclosed in our quarterly results was the global supply chain for energy infrastructure, for new parts, for new components, is entirely strained. So it's not particular to just Net Power. And so a lot of today was really just level setting with investors in the broader community around what the supply chain looks like, and really just setting the realistic expectations of when our first utility scale plant that really transforms natural gas into one of the cleanest forms of power will come online. So what we ended up talking about with investors today is we said, look, we need to build a 12-month cushion into our commissioning time for our very first plant.
Right.
So we moved from 2026 into the back half of 2027. So certainly disappointment, but sometimes things are out of control, and it's really important that you have a well-capitalized balance sheet to be able to withstand those uncertainties. And
Danny, that's actually exactly where I wanted to go, because I wanted you to indulge me and talk about power of cash. I mean, your cash balance sheet, $645 million on the balance sheet, no debt. I mean, that is a hefty return in this world where rates are high. When do you start thinking about running down some of the cash? Or you say, as long as we're in this regime where rates are high, we want that nice cushion to earn a return on?
Yeah, I think for us, as we look at it just being a pre-revenue company, it's really important that you have the capital to be able to last through commercialization when you really start to realize significant revenue. And so when we took the company public back in June of this summer, we intentionally overcapitalized the balance sheet to be able to ensure that as you hit bumps and fits and starts along the way, that we have the capital to get through commercialization and beyond. And so we do. We began the quarter with $648 million of cash, and we ended the quarter, when you factor in G&A and CapEx and all the things that we're spending money on, we ended up with $645 million of cash on hand. So I think we demonstrated that we're prudently reinvesting that cash into things that are earning 5%, 5.5%, just with inflation. And so I think when we look at the future and when we're going to get to commercialization, the expectation is we're still going to have a significant amount of cash on hand. So I think that should give investors a whole lot of just cold comfort that even with a 12-month delay in just commercialization of this first plant, which is the most important plant we're ever going to deliver, the company is going to be well capitalized at that point in time.
Well, and I wonder how the financing and economics of Net Power relates to where I sit here in Washington, Danny, where, of course, President Biden, one of his primary legislative accomplishments was the passing of the Inflation Reduction Act. What is your relationship with that kind of funding? Are you applying for funding from the IRA? Will you in the future? How does it change the economics for you when you think about some of these carbon capture incentives?
Yeah, so the carbon capture incentives that you're talking about under the IRA is really a program called the 45Q, where the federal government will pay you for each ton of CO2 that you sequester. In our plant, just because of this proprietary process that we have called the Alum cycle or the Net Power cycle, what we're doing is we're inherently capturing all of the CO2 being generated from this power generation process. And so with that capture of the CO2, it gets sequestered, and that 45Q payment, which is $85 per ton, when we permanently sequester the CO2, it gets paid to the Net Power plant owner. Now, these plants are capturing over 800,000 tons of CO2 per year. And so these Net Power plants make as much money from sequestering the CO2 as they do in generating power. And so it's a really interesting proposition for potential customers of Net Power, because not only do you not only have one source of revenue from power generation like everybody else, but you have a second one that's actually more valuable, which is removing the emissions from power generation.
Okay, Danny, I'm afraid we're going to have to leave it there. Thanks so much for joining us. That is Daniel Rice of Net Power. Kelly, let's quickly look at these markets because they continue to roar. You have bonds front end of the curve down 18 basis points. That is the biggest move since March of this year during the U.S. banking drama. You have the bond market, iOS, completely wiping out bets for any more rate hikes to come. Instead, you have bets for cuts to start as soon as June, maybe even as soon as May. It's happening globally, it's happening across the curve, and it's also happening just as we had a Bank of America report saying that bond longs were the most since 2009. So some people making some serious money today, Kaylee.
Yeah, and of course it isn't just limited to the bond market, Danny. As we have this repricing of expectations about when the Fed is going to start easing once again, you have a massive rally in risk assets. The S&P 500 and the NASDAQ 100, of course, more tech heavy, a little bit more sensitive to those higher borrowing costs, are up more than 2% each. And Danny, you point me to the small caps. The Russell 2000 index up 4.25%, best day for that gauge going back to November of last year. So a really massive move in some of those smaller stocks. And of course, it isn't buy everything. When we're thinking about a Fed that may do less, may start easing, you're seeing some of that dollar weakness coming through today as well.
Yep, sterling euro taking off more than 1% versus the dollar. All right, coming up, we're going to talk about the bonus season at the big banks. It's looking more bust than boom, thanks to rising rates and falling deals. Maybe today offers a glimmer of hope on that regard. We're going to have details in our Wall Street beat next. This is Bloomberg.
It's time now for Wall Street Beat, where we look at what's buzzing on Wall Street in the world of banking and finance. And today, we're looking at bonus season. I know this is everyone's favorite subject, but hate to break it to you, it's looking grim out there for bankers. Joining us now is Bloomberg's Sally Bakewell with more. So, Sally, how grim are we talking here?
Well, last year it was pretty disappointing. This year it's going to be pretty disappointing, and I think next year bankers are going to face more disappointment. So because of, this plethora of reasons, a prolonged deal slump, rising interest rates, stock market volatility, general inflation and cost pressures, we're going to see bankers facing, lower or flat bonuses this year, and particularly hard hit will be those that advise on mergers and acquisitions, because the deal market has really been in this prolonged slump. We'll also see that bankers handling commercial and retail business in some of the regional banks could expect their bonuses to fall some 20%. For mergers bankers, it could fall as much as 25%. But there are some bright spots. Equity underwriting, they could see a bit of a bump of as much as 15%, thanks to the IPO market bouncing back a little bit in the later part of this year. And wealth management also, they could see a bit of a bump. So it's not all bad news, but I think the news ultimately is prepare to have a flat or lower bonus this year.
Sally, what about some of the Goldmans of the world, for example, or UBS, who have kind of an image issue and are trying to hire up more people and have more incentives? Is any of that showing through, or is it just those really specific cases?
I think some of those banks like Goldman Sachs, they have made cuts to some of their staff. They have had to, they're grappling with inflation, and they have had to, and this prolonged deal slump, and so they've had to make some fairly significant cuts among some of their staffers, as have banks like Morgan Stanley and Citigroup. No one's really been particularly immune to this slump and to these conditions, but obviously, it's these banks, they do know they have to pay up for talent and they want to retain their best talent. So for those staff, they will probably go out, and bat for them. And we also see banks like Moelis, which are actually going on sort of a bit of a hiring spree, taking advantage of these conditions, and that other banks are retrenching to sort of stock up on talent for when markets start to bounce back. So it's a very difficult thing for banks to navigate because they have to keep a lid on costs, but they probably have to, and one of the levers they pull for doing that is to cut staff, but at the same time they do want to keep talent for when the market starts to rebound.
Well, and Sally, I remember the days not too long ago when it seemed like each and every day, because of this competition for talent, we were seeing a new headline about how much junior bankers were going to get paid at whatever shop they decided to go to. But it raises the question of what's going on with base compensation. If bonuses are going down, are they getting more money coming in consistently all the way up the pay scale, not just for the junior people?
Well, that's the interesting thing. For bankers, the size of their bonus usually dwarfs their base salary. Managing director can get paid from sort of $350,000 to $650,000, but the actual bonus can, boost that pay many, many times. So what they're actually paying at a base level, they're in this sort of complex situation of having to retain talent and paying up, but at the same time keeping that lid on costs. So it's hard to say really, what that looks like for a banker's bottom line salary.
Sally, thank you very much. That is Bloomberg's Sally Bakewell. We're going to have more Wall Street conversations coming up. Sonali Basak is going to have an exclusive interview with Citadel CEO Ken Griffin today at 1 p.m. New York time, but in Miami, so, Wall Street on tour. Meanwhile, let me show you what these international markets are doing. What's happening here in Europe, all in reaction to the CPI. Some massive moves. The dollar is getting crushed today. To the upside, the euro is now trading at its highest level in more than a year versus the dollar. We're up 1 1/3%. We're at 108. It was also supported by ZEW, that survey coming out earlier in the day, showing that there's confidence among German businesses, more than expected, so that puts it another leg higher. Sterling also off to the races, up 1.4%. We're at 124.52 on cable at this moment. You also had some hotter wage data come in, 7.7% for the UK. But hotter wage data also mean you'd think that yields would be higher. That's not exactly what's happening. In fact, a huge rally in gilts too, down 14 basis points for the 10-year yield. Again, just mimicking what we are seeing in U.S. bond markets. We did hear from Saxo saying that this should be at 5%. That's what fair value is. So maybe some